The Liberal government reached a deal with Beijing last Friday that would ease trade tensions between the two countries. Prime Minister Mark Carney announced that Canada will slash tariffs on a limited number of Chinese made electric vehicles. In return, China has agreed to drop duties on Canadian agricultural products. The Prime Minister is calling it a preliminary but landmark agreement, saying it removes key trade barriers and lowers tariffs as part of a broader strategic partnership with Beijing.
And to help deliver the full potential of these partnerships and bring down costs for Canadians, Canada has agreed to allow up to 49,000 Chinese electric vehicles into the Canadian market, with the most favored nation tariff rate of 6.1%. This is a return to the levels that existed prior to recent trade frictions. But it's a return under an agreement that promises much more for Canadians. It's expected that within 3 years, this agreement will drive considerable Chinese investment in Canada's auto sector, creating good careers in Canada and accelerating our progress towards a net zero future and the auto industry of the future. With this agreement, it's also anticipated that within 5 years, more than 50% of these vehicles will be affordable EVs with an import price of less than $35,000. By March the 1st, Canada expects that China will lower tariffs on Canadian canola seed to a combined rate of approximately 15%. China is a $4 billion canola seed market for Canadian producers, and this change represents a significant drop from the current combined tariff levels of 84%. Furthermore, Canada expects that Canadian canola meal, as well as Canadian lobsters, crabs, and peas, will not be subject to relevant anti-discrimination tariffs from March 1st of this year until at least the end of this year.
For Western Canada, the new Canada-China trade deal is being seen as mostly good news, even amid valid concerns about autos, sovereignty, and national security. At its core, the agreement helps diversify exports to Asia, covering agri-foods, lumber, and energy at a time when depending too heavily on the U.S. has become a growing strategic risk. To break this down further, I'm now joined by Gary Marr, the president and CEO of the Canada West Foundation. Gary, thank you so much for the time today.
My pleasure to be with you.
Now, how does this deal with China impact investment and production levels in the oil sands?
Well, it's too early to tell right now, but I would say this that there's already been an increase of exports of petroleum products to China, first of all, through the Trans Mountain Expansion Pipeline. I think a lot of people expected that when that pipeline was opened, it would be moving oil to refineries off the west coast of the United States. But in fact, a lot of it has been going to China. So at the first instance, what I think you'll see is that pipeliners will want to increase the capacity of the existing infrastructure that's already in place by putting in more compression stations and pumping that oil through pipelines from Western Canada to the West Coast at higher pressures and therefore greater volume. I think it's also worth noting that products like LPG, liquefied petroleum gas, or what we sometimes refer to as propane or butane, AltaGas is a company that started moving it through a terminal in Prince Rupert, and they already occupy 6% of the Chinese market in less than a year. I think that's an important fact to bring forward. So, to put it all in context, the United States is the largest consumer of oil in the world at 20 million barrels of oil a day. China is a close second at about 16 million barrels of oil a day. And although the use of oil for transportation perhaps has flattened, the growth in oil demand continues to rise in China, not because they're using it more for diesel or gasoline or aviation gas. That's kind of flattened out, but they still use oil for all kinds of petrochemicals that are used to produce everything from fertilizer to plastics. It's component in things like solar panels. And so I think we're going to continue to see the opportunity to diversify our market, our exports of oil to what is the largest importer of oil in the world, not the largest consumer, but the largest importer. And then also this week, The Alberta government is in China, or not in China, in India. And India is the third largest consumer of oil in the world at about 6 million barrels a day and growing. So I think the opportunities for moving Canadian petroleum to markets other than the United States is an important step in the right direction.
Now, I want to step away from oil for a second and move on to some critics have raised concerns about auto's national security and sovereignty. How should Canadians weigh those concerns against the potential economic benefits of this new deal with China?
I think it was clear from the very outset that what the Prime Minister was trying to achieve in this deal with China was he wanted to increase the economic opportunities for Canada without taking anything away from national security risks. And I think by and large, he's been able to do that. But to put the auto sector in context, and I think the Prime Minister did this in his comments, is that 49,000 vehicles that will come from China is exactly the same number that was prior to the uh, Trudeau Biden 100% tariffs on EVs. And so it's not a significant change in any way, shape, or form uh, as it relates to the auto sector in Ontario. Now, Doug Ford says that these vehicles are going to be bad. They're going to take away jobs. Well, I don't see any BYD dealerships in Canada now. If these vehicles are bad, then they'll go the way of the Lada or the Skoda. They don't have the infrastructure to maintain them, to fix them. And so that is why the idea that if these vehicles have a marketplace in Canada, it will make sense for Chinese infrastructure to come over and manufacture these, probably in Ontario. And as Premier Ford said, with the use of Unifor employees, I think that that's probably a good deal. We don't see it in the short term, but in the medium and long term, this could be an important step.
And what are the risks associated with increasing partnerships with China like this?
Well, over the years, we've seen the China-Canada trade relationship go through cycles of wild optimism to complete despair. At the bottom end, of course, was during the period of incarceration of the two Michaels, and who spent over 1,000 days in a jail in China. But I think that this is a step moving up. We shouldn't. The risk is that you don't want to be overly reliant upon one marketplace, including China, because as you can see that China has used our reliance upon them as a political tool for leverage vis-a-vis Canada on other issues. And so that's also true of the United States. We shouldn't be too dependent on the United States as well. I think that it's a good idea to be diversifying our marketplaces for what we sell. If there was any criticism that I had of the Canadian government, it's that they didn't make as part of the mission going to Japan and South Korea first and striking deals there, because those two countries have really upped their diplomatic game here in Canada and have come to Canada looking for things like energy and other commodities. And so, had the Prime Minister's mission gone to those two countries first and struck deals there, that would have even been better than just going to China by yourself. But having said that, I think these are steps in the right direction. But the risk is, of course, you don't want to be too reliant upon any marketplace, including China.
And would you say that there's potential for Chinese investment in Canada's oil and gas sector? And does that present a national security risk?
Well, here's the thing: is that uh, we've had Chinese investment in the past. Back in the years in the early 2010s, Stephen Harper opened it up for Chinese investment, and you had companies like CNOOC coming in and investing some $15 billion, almost $15 billion, to buy out Nexon Energy. We could open that up again, but know that the rules would be played by Canadian rules. The oil is not moving anywhere; it's geographically located here, And so, would we have risk in terms of, um, in terms of selling oil and allowing investment of other countries? I think the answer is there's potential, but it can be mitigated because we're the ones that govern the rules of where the oil rests, and you can mitigate against some of those risks by putting in proper regulation.
Well, Gary, thank you so much for the time. We appreciate it.
It's my pleasure. Thank you very much.